2020. Every convert, every junk bond, everything sold, every municipal bond, whatever you could imagine. The single best performing bond was MicroStrategy convertible bond, where you could have doubled your money. You know, at some point it was trading insane amounts, like triple, you know, your money on a bond. Okay, so we had good success there, and of course Bitcoin kept moving up, and our stock kept moving up, and we realized by February that we could do another offering. The next offering was, we came in the market offering $600 million. The first one we started with $400 million. This time we started with $600 million. But again, it was oversubscribed. We upsized it, exercised the green shoe. It became a $1,050 million offering. And the range was 50 basis points to zero. So we struck it at zero. And you know, up 50, 37, I forget the number, but we ended up having a 50% premium or 47%. I forget exactly. It was a high premium. It was a low coupon. The strike price is $1,432 a share. So now put this in perspective. This is 10 times the price of the Dutch auction, you know, some number of months earlier. Now, so why'd we do that? Well, because if you could borrow $1 billion at 0% interest and invest it in something going up 170% a year,
pretty good trade.
Why wouldn't you do it, right? Like every single business on earth that's debt financed presumably is borrowing money to invest in something which is going to return a higher yield than the cost of the debt. Now, I want to pause here and make one point. The reason that I was sensitive to inflation was I immediately saw the inflation in March and April in the stock market, right? Because my inflation bogey wasn't, if I were to go to all my investors and say, I got $500 million, I'm investing it at 2% interest and inflation rate's 1%, they wouldn't have given me a pat on the back. They would have said, the S&P index is moving up 10% a year. Your hurdle rate, your cost of capital is not 1% or 2%, it's 10%. And maybe you're getting 5% yield on a piece of debt, then I don't hold my nose, but you're losing 5% a year. Half-life of the money is 12 years. Okay, fine, but like you shouldn't be holding it. You should be buying your stock back or buying another company with that. Sitting on that cash it doesn't make any sense. Saifedean says the dollar-weighted monetary inflation rate across, you know, all currencies for the last 30 years is 14%. Interesting number he comes up with. 14% is the inflation rate of the currencies. Now, that would be the inflation rate on scarce desirable assets or any portfolio of assets. And if I look at my screen right now, over the last 10 years, the S&P 500 is showing 14.15% interest, or 14.15% compounded annual growth rate. NASDAQ's up, you know, whatever, 19%, you know, gold is up 20 basis points, nothing. Bitcoin's up 170%, right? And long bonds give you like 2.5%. So the monetary inflation rate equals the S&P index. Well, the traditional way you'd value a stock is you would put a risk premium on it, and you would say, well, your cost of capital is the return plus the risk premium. So it used to be we'd think, well, there's a 3% risk premium, and the inflation rate then would be 11%. But I think that if you buy the S&P index, you're kind of in theory stripping out the risk because you're buying 500 companies. So the S&P index can be viewed as a proxy for monetary inflation. And the question of inflation is, what's your inflation rate? Well, what do you need to buy? If you're a consumer, then your inflation rate might be CPI if you agree to buy what the Federal Reserve tells you should want, right? And the market basket of things in the CPI is what the government says you should want in your life. But they never included a Picasso or a jet or a yacht or a house in Miami Beach in that market basket.
a step even further than that is the number 14% is very interesting, because my understanding is if you go back, obviously CPI used to represent a cost of goods index. So what is literally the change of price of individual goods year over year over year, and that's how inflation was measured. Now, obviously, we have a cost of living index, which is what you're talking about in terms of, well, here's the things that we think you should want. Here's the general weightings of these specific assets or consumables inside of this basket, and then that's kind of our moving target for this measurement of inflation. But if you were to go back and look at the cost of goods index based on how it used to be calculated for CPI and apply it to today's numbers, you get about 14%. And so not only is the S&P, not only is that monetary inflation, but also that cost of goods index based on the original calculation of inflation is around 14% as well, which is, there's coincidences in life, but it seems to keep coming back to somewhere in that kind of mid-teen number when we're trying to understand what is that inflation.
Yeah, isn't it interesting? The hedonic adjustments kill you. But on the other hand, and I say this oftentimes, inflation is a vector, and what I mean is you got to use multi-dimensional arrays and linear algebra to even start n-dimensional linear algebra to even start to deal with the issue. Another way to say it is you can calculate a different inflation rate for any person in any jurisdiction based upon their mix of products, services, and assets they want to acquire. And so common sense says a person that wants to acquire a set of manufactured goods and wants to watch streaming YouTube has a lower inflation rate than someone that wants to buy Picassos. Now, what if you want to be rich? If you want to be rich, your inflation rate is very high because you have to acquire assets. If you want to be middle class, your inflation rate is different. So back to why I did what I did. If you're the CEO of a publicly traded company, your inflation rate is the cost of capital. And the cost of because your shareholders hold you to that cost of capital. If I go to a public investor and I tell them my goal is 2%, and they're saying, well, the S&P is up 14%, then I'm undershooting their goal. Their index is the S&P index, right?
Correct.
So the inflation rate for an investor is the index. Now, of course, different investors have different indexes. If you go back to the strategy, if you're a fixed income investor, you've got like a sovereign, or corporate fixed income rate. You've got the junk bond index, you've got the corporate, investment grade index, you've got the sovereign debt index. You have capital structures in the world that have different indexes. Someone that wants to send their kids to an Ivy League school and wants to have a house in the Hamptons, right? They have a different index. Someone that wants to be obscenely wealthy has a different index, right? So that's why you could have everybody talking past each other because and of course, if you keep changing the indexes, the S&P 500 index changes, right? They rebalance it. The PCI, the PCE indexes, they get rebalanced. So the indexes are changing. And if you allow someone else to feed you the index they want you to focus on, well, you can see it right now, right? The official inflation rate in Canada is 4%, but the housing price is up 15%. The official inflation rate in the US is 5%, but the Case-Shiller index is up 27%.
Something big.
Okay, and of course, it all comes down to deciding what you want in life. Now, in the last 12 months, the S&P is up 34%. If you're sitting on $100 billion worth of cash and you put it in the S&P index, you got $34 billion back. You have $134 billion right now. If you held it in conventional treasuries, you're short $34 billion. If you convince yourself that the inflation rate was 5%, or if you convince yourself that you could say, look, my treasury index is just the short-dated sovereign debt index. And so as long as I'm beating the 20 basis points, I'm good. And by the way, like if I have a bunch of money sitting in a bank, my bankers come to me. I've literally had bankers from the big wirehouses, they came to me when I'm sitting on 100 million or 200 million in cash, and they go, we can get you into one of our money market funds that'll yield 22 basis points, and that's much better than the 9 basis points. And they're selling this to me. There are people in suits that make a lot of money, and they're selling it to me. And you read the prospectus, and the prospectus is they're going to do something, and they're going to charge you a 27 basis point fee to generate 22 basis point yield to you. You're literally...
They're making more money than you are.
You're giving 60% of the yield to someone in a suit that's giving you a service to get you 5 basis points more. But there are people that convince themselves that this is a good idea, right? And we come back to that in a second. It's an important truism in the market. Why is it that everybody hasn't bought Bitcoin? People ask that, right? All the Bitcoiners wonder, why don't all these investors buy Bitcoin? And the answer is because there's trillions of dollars of capital locked up in capital structures that are chasing a different index. Right? There's trillions of dollars of money sitting with people that think that inflation is CPI. There's trillions of dollars sitting in real estate funds, and they're trying to beat CPI. If I got rents and I'm raising them at the CPI rate and I'm happy with it, there's trillions of dollars invested in fixed income funds where they have to beat the junk bond index or beat the corporate index or beat the sovereign index. And if they beat the sovereign index, if I have $20 billion and all I got to do is beat, the junk bond index or I get paid, then I'm getting paid to invest $20 billion to get 50 basis points more.
What happens to those people? Let's say that inflation isn't 5.1% or 5.4%, wherever it comes in on a monthly basis now. And we all agree it's something that is higher, but there's disagreement on how much higher. Is it 6% or is it 14% in terms of the actual inflation number? What happens to all the people who are using CPI as the benchmark? Do they just succumb to the inflation over time and continue to lose money until they wake up or something else?
I think a lot of people have a hybrid situation. Like, for example, let's say I run a real estate trust or I run a real estate company and I have $100 million a year worth of rental income. It's capped at CPI. The leases are signed 10 years, 20 years, 30 years duration, 5 years duration, and then you've got all the trade relationships. Like I can't go to the people that rent my building and tell them that the inflation rate's 14%. Right? I mean, would you pay a 14% increase in your rent here? No. So there's a certain inertia in parts of the economy where they're going to move up at CPI, or they're going to be flat, or maybe they can do double CPI. But at the same time, maybe you're the person running that real estate company. You're thinking, well, I'm going to take my cash flows and I'm going to invest them in. Would you invest them in a stock that you thought would go up at CPI? Or would you invest them in the S&P index if you thought you would get CPI? Not really.
Yeah.
So what you have is you have people that are sweeping their cash flows from an operating business that's low growth, and they're putting in the S&P index. If
they're looking for the growth to come from the investment.
Okay, the S&P is up 34%. How many companies in the world generated 34% more cash flow or raised their prices by 34% or grew their revenues 34% in the last 12 months? Not many, right? Yeah. 98%, 99%, they're in a fiat operating system where they're going to raise their prices or generate cash flows at a rate slower than the rate of monetary inflation. But those same people will turn around and they'll buy Bitcoin, or they'll buy property, or that you may buy property that is going up faster, right? There's not a single commercial